Welcome to the Motor Carriers Insurance Education Foundation's in-depth review of coverages addressing the unique operations of a motor carrier. This session will be looking at auto liability, but looking at specifically described autos symbols. This webinar is not filed for state CE credit and is a learning opportunity only. If you have any questions, please send an email to trs@mcief.org. The auto liability insurance agreement says, coverage, we will pay all sums an insured legally must pay as damage because of bodily injury or property damage to which this insurance applies, caused by an accident and resulting from ownership, maintenance, and use of a covered auto. So the key part here is that the first thing that's get looked at when a crash happens is, was the crash caused by an auto that qualifies as a covered auto? So we're going to look at what's a covered auto. There are the numbers listed in item 2. Those are the symbols. For the policy to respond, the accident must be caused by an auto that meets the description of the symbols that defines a covered auto. We list these in item 2, schedule of covered autos and coverage and covered autos. This policy provides only those coverages where a charge is shown in the premium column below. Each of these coverages will apply only to those autos shown as a covered auto. Autos are shown as a covered auto for a particular coverage by the entry of one or more of the symbols, meaning numbers, from the covered auto section of the business auto or motor carriers form, which would have the same wording next to the coverage. These are the 7 items that are dealt with liability. The only one that's really important here is the first line. That's the liability in case a crash happens, of how much the insurance carrier will be obligated to pay on behalf of the insured. The personal injury, added personal injury, property protection from Michigan, auto, med pay, uninsured motorists, and other things can also be triggered for these, and I consider those liability too. But the key part is the liability coverage, where we would have one or more symbols in that column, the covered auto line, and you would have a limit there, either $750 or $1 million, and would be in most cases, and you'd have a premium charge. Policies will use numbers to tell what type of autos, as it relates to the insured, will require the auto to respond. These numbers will be shown in item 2, which we just looked at of the deck and documented. This has to be a number for all coverages needed. There has to be a number for all coverage needed. The numbers of symbols will have meaning. It defines the autos that are covered autos, therefore the policy would respond. The insured must have the correct symbols to have coverage at time of accident for each coverage needed. Things unique to truckers, motor carriers. These are the government regulations. They must register, and they must prove financial responsibility imposed by the federal government or state government. The insurance provider meets these financial responsibility requirements. Those promise to protect the public, including both owned and non-owned autos, and there is, even though there's no coverage in the policy. If there's no coverage, then still would be obligated, meaning insurance provider, to address the damage to the public because of the 91X filings, MCS 9 endorsement, or the state Form E's. These financial requirements do not provide coverage to the insured, not even defense, but do obligate the insurance carrier to pay a judgment rendered against the insured when there is no coverage in the policy. The financial obligation, the insurance carrier who provided the proof of protects the public only. If there's no coverage in the policy, if the accident was caused by a commercial motor vehicle, a vehicle 10,000 G or larger, whether or not it is specifically described on the policy, the insurance carrier who made the filing would have to protect the public. Second part of this is our premium base for exposures is per auto. They're filed by the state rate, and we get so much per auto. That would include both the power unit and the trailer. This is one thing that's unique to motor carriers. Most of our charges are for a combination of a power unit and a trailer, where actually ISO divides the two up into two different premiums. That's the technical part about how policies are determined, premium are determined. What we'd want to cover is all, as a covered auto, is all power units and trailers that the motor carrier operator operates as part of their business and under their DOT registration or MC number if they are hauling processed goods of others, interstate commerce. We want to cover both owned units as well as non-owned units. So we make sure that we are getting the right premium for the exposure going in. There's a verification of units used by the motor carrier. This is also unique to motor carriers, is our ability to determine, or at least to try to verify, determine this. Underwriters, to establish estimated premium, meaning going in at inception, they monitor during the policy inspection with reports. And at the end of the term, they have an audit. So an underwriter estimates the premium at inception by looking at the public information, looking at reports. During the policy term, they will monitor the units our insurers use by the inspections at the roadside or some reporters that would be required. And at the end of the term, they have the right to audit in case if they were not properly adjusted during the policy term. So the information from the insured. We know about most of their own units. Why? Because first off, they are the ones that get repeatedly inspected. Second is they're the ones that we probably will have furnished physical damage or at least know about physical damage. Or when they buy it, they would need a proof of coverage for license plates that would require the serial number. We also can look at the financial statements, either audited or not audited. And for every $200,000 worth of revenue, there's probably a unit. Non-owned autos would look at the lease, and that could be the financial company leased by from a financial leasing company or an owner-operator, and that would be a function of the 1099. So we look at the financial statements, we look at the revenue, we look if they have any leases, we look at if there's finance obligations to leasing companies, or we look at how many units or how much 1099 money is paid by the insured. We also can look at SAFER, information provided the motor carrier to the government in the 150. They must update this biannually every 2 years. What they'll show is the number of power units, the number of drivers, and the number of miles. And what we would try to match up is for every power unit that has a driver, there must be about 100 to 105,000 miles equals a auto, which we need a premium for. We also then can look in the SAFER and see the roadside inspection. The unit serial numbers are listed on these inspections. So we want to review the units by serial number that have been inspected before we provide the quotation. We look at the last 6 months or even a year, and we want to make sure all of those units are considered in our quotation. But then after the initial inception, units not on the list, the schedule, we'll find out why not. And if not, and if they're not there, we'll either add them to them or do an audit later. But we look at going in, are we insuring all the units by looking at past inspections, and during the policy term, we will also monitor the vehicles that are being inspected, and so we can get the proper premium. Specifically described autos. This is symbol 67. Specifically described autos. The insured must understand they have to tell the insurance carrier about all autos they are using. This is a concern that we have, and this is why we go back, like we did the slide before, to look at the ones that have been inspected and track the ones that are expected after policy issuance, so that we make sure whenever possible, we make sure that all vehicles the insured owns and operates will be scheduled on the policy. Notice it says only those autos described in item 3 of the declaration of which a premium charge is shown, going back to the symbol in item 2, then a vehicle will be scheduled in item 3 that we'll look at in a minute. And here's a point here we sometimes overlook. And for liability coverage, any trailer you don't own while attached to any power unit described in item 3. So that's only non-owned trailers. If the trailer is owned, then that's a covered auto, and that trailer must be considered a schedule in item 3 or have some method to make it a covered auto. This is important consideration, and there's some insurance carriers who handle this by putting on the schedule any non-owned trailer, or excuse me, any owned trailer while attached to a described unit. That would cover those, but the problem with that wording is attached to. You need to be very careful about those attached to requirements, and you also need to be very careful about trailers the insurer does not tell you about. Clearly, if it's attached to a power unit running down the highway, owned or non-owned, there would be some coverage probably provided there because the power unit typically is the instrument that caused the crash and that would be involved in it, and we would have to defend that damage done by that power unit, even though the trailer would not qualify as a separate covered auto. But we don't want to have that circumstances if at all possible. The key point of policies that I have written in the past is I want to set the policy up so after something happens, somebody doesn't have to determine what I meant to do. So the key part here is you need to address all trailers, all owned trailers. They need to be qualified as a covered auto. The way you do this on a specifically described auto, symbol 67, is schedule the trailers on the schedule 2 of the, schedule 3 of the declaration, either by serial number or a broader coverage, as we said, while being used by or while attached to a covered auto. I don't like the word attached to a covered auto. I'd rather use with and or responsible for, any trailer used with a covered power unit. Why? Because we could still have some liability when that owned trailer is not attached to the power unit. There's 2 examples that I've used, one of which involved in the crash in a case that I had with one of my insureds, and second one reported to me. The first one was the policy was written where the power unit was described, and the words that were covered trailers is any owned trailer while attached to a covered power unit. But this trailer happened to be sitting on the insured's yard in Memphis, Tennessee on a very hot day, and the landing gear sunk into the asphalt, which was freshly paved, and fell on top of the snap-on tool person's vehicle parked next to that trailer. Fortunately, there was nobody in that vehicle, but they did wipe out the vehicle itself. And when it came down to coverage, it was not covered because that trailer, not attached to a power unit, is not a covered auto. In this presentation that I was doing, when this example was brought up, I asked the agent, well, how did it get covered? And he smiled and said, under my E&O. That's the exposure that you have here. This is why trailers not attached, even on insured premises, are not covered auto, because they're not covered under GL, because they're not mobile equipment, because those trailers are tagged for the highway and typically are being used away from the insured's location. So therefore, they would not be covered under GL. The example I used for that happened in a situation that I had is I was riding harvesters in Florida, and typically orange harvesters have many trailers. I had one insured with 15 power units and 300 trailers. They keep the trailers in the fields, they keep the trailers in the processing plant, they keep the trailers going to and from the processing plant in the field. This particular trailer was sitting in an orange field outside in Polk County near Winter Haven, Florida. It was a dirt road going through it, but it was a public road. The actual orange field was owned by Ben Hill Griffin. For you who are football fans, know that the Florida Stadium, which is called the Swamp for football, is the Ben Hill Griffin name for Ben Hill Griffin, who is a large grower in Florida. A bartender, after her work about 11:30 at night, was coming down this dirt road. She lost control ran off the road and ran into this parked trailer being ready to be loaded the next day. She had to be helicoptered out, and we got a suit. Now, obviously, we defended it. In this case, fortunately, I had it covered because we had the proper symbols in the auto. But again, if we had not, or we had that wording any owned trailer while attached to, there'd be no covers in that form, no defense and no coverage in those areas. So this is why it's important to understand that specifically described autos only address the power unit, not the trailers. The trailers must be considered a covered auto if they're not owned while attached, but if they're owned, then they need to be listed in item 3 of the declaration to make it a covered auto. So if covered auto is symbol 6 or 7, then the vehicle involved in the accident must be scheduled in item 3 to meet the definition of covered autos. If not described, then not a covered auto at accident time. Specifically described autos will be used for most policies you write. Why? Smaller motor carriers. 85% of people with MC numbers. The reason I focus on MC numbers instead of DOT numbers, MC numbers are the for-hire interstate truckers who are hauling processed goods in interstate commerce. Those would be the core businesses that members of the Motor Carriers Insurance Education Foundation is their core business. These for-hire truckers. I realize you're exempt that we live here. Those are the orange haulers and the meat haulers, but this gives us a sense here. 85% of people with MC numbers have less than 5 power units. 90% have less than 20 power units. And so you're not going to be in this marketplace. Most insurance companies that insure for-hire interstate motor carriers provide coverage based on the list of autos for anyone less than 20 power units. This is the important part here. So the great majority of all policies that we'll write will require the vehicle to be specified on the policy to be a covered auto. And so this is the concern we have with use of the specifically described symbol. The MC holders cannot operate also without a filing. That's the 91X. DOT, if for-hire interstate has an endorsement on the policy, must have an endorsement on the policy, and that's MCS 90. So even the ones who do not have MC numbers, exempt haulers would need an MCS 9 in the policy. Both protect the public if insured use an auto in their operation under the authority that's not a covered auto, not specifically described. Both of these endorsements say, and regardless of the vehicle to be being specifically described in the policy or not, the insurance carrier who made the filing or provide the endorsement still must pay any final judgment rendered against the insured. So that's how this is why it comes back, and actually the federal rules talk about the vehicles that are not specifically described would still require the insurance carrier who meets these financial responsibility requirements on behalf of the motor carrier respond to protect the public. So we want to again verify all the units used. Mileage. Safer shows about 100 or 105,000. IFTAs. That would be a good source of it. Those are the quarterly reports that have to be provided by the federal government. And again, those are for the miles traveled in each state. That only shows us where the miles travel, but also it shows us where the insurance is going. Or a new area we could use is electronic log devices. This gives us the exact measurement of the total miles they use, but we need to figure miles, and for about every 100 to 105,000 miles, there will be a power unit. Again, we have the inspection. The vehicle listed on the roadside inspection the last 6 months or 12 months before offering a quotation. So must have all units inspected, listed on the policy, unless confirmed with the insurer they no longer have it. Either they're sold, or if it's an owner-operator, the lease is canceled. After policy issuance, then again, the inspection is monitored. The unit's inspected not on the policy. The insurance carrier will ask you, why was it on the policy? And if you don't have a right answer, they're going to send a bill for an audit or go ahead and automatically add it to the policy. So, considerations specifically described. Non-fleet, insured has less than 20 power units. So then insured carrier will require the auto to be listed to be a covered auto, both owned and non-owned. If the non-auto unit is being operated as part of the business of the insured, the motor carrier. Again, they do all they can to verify going in that they have done this. All units owned or leased must be scheduled. Covered autos, number of units, types of power units, tractor, straight job, medium trucks, those would be anything 10,000 GVW or larger, or trailers themselves. Those are the ones that we have that we would want to make sure that we are addressing coverage on all these units and make them a covered auto, whether they're owned or not owned. So we're going to list the vehicles, each specifically vehicle listed, year, make, model, and the 17-digit VIN numbers. We'll spend a second here on the 17-digit VIN numbers. The VIN number is made up of two components. The first 8 numbers are the components of the vehicle, the power unit, the engine, fifth wheel, type of truck it is, the make and model. The middle letter is the manufacturer, and the last 8 numbers are the unique part of this. What location manufactured it, and the number coming off that day it was manufactured, and the number coming off the line. One of the things we're finding in this marketplace, because electronic logs and other things, is sometimes you'll have a vehicle with only 9 serial numbers. Once you verify they only have 9 serial numbers, and that's right, then you know they've used a glider kit. A glider kit is a unit that the insured buys with no powertrain, no engine, no transmission, no rear axles. The insured then buys these cab and the rail, including all the features of the cab, including fuel tanks and those things, and they put these components into it. So what you have is a truck with a new title but old components. So if you ever run into that, that's why it will not be legitimately have the 17 digits. But other than that, you want to get all 17 digits and verify that those are the units that we're scheduling on the policy. Now we're scheduling on policy. This is item 3. Schedule the covered autos you own. Big concern here, because what we're saying is we want all autos, the ones owned by the insured as well as the ones operated by the insured. Those would be the ones that they lease, be scheduled here. Yet on item 3, we can't schedule vehicles that are not owned. So one of the things that we do a poor job of as a retail agent, in my opinion, is asking the insured who owns the autos we schedule here. Sometimes they'll say, I do. If it's an LLC or a closely held corporation, subchapter S corporation, you got to ask them what I meaning the corporation, or I meaning me personally, because that's the concern here. They're going to be vehicles that will be scheduled here could be owned by other than the named insured on the named insured line. That's the legal entity on the named insured line. It could be a leasing company like PACCAR or Ryder. It could be owned by the owner of the corporation who owns the vehicle personally, even though now the corporation is operating it. And thirdly, it could be an owner-operator. Those are the units that need to be scheduled here. Notice you also would want the VIN numbers. Those are the serial numbers that we just talked about from the inspections. So symbol 67 requires the autos to be listed in item 3 to be a covered auto must be owned. If not owned, you need an endorsement. The first endorsement, CA 9947, employee as lessor. This is the one that we overlook, and in my opinion, this is the one that we have the most exposure on here. That's owned. The vehicle and we're talking about here are ones owned by the owner of the company, who also owns the vehicle personally, but uses in the business of the motor carrier. How could this happen? Well, there's an effort that we all think we're trying to tell our insured is they don't want to operate anymore as an individual. So they have a truck they bought. That truck's on a 5-year payment plan. They buy individually in their own name, either because of they were operating at that point as an individual, or because the corporation or LLC has no financial backing, and so therefore they buy it personally because the corporation and the legal entity does not have the financial strength to justify the loan. Either case, they own it personally, but now the motor carrier that they also own, the separate legal entity, is using it. And it's on that motor carrier's separate legal entity auto liability policy. What we don't understand here is, and a lot of owners don't understand this, they think they have protection for the liability for owning that vehicle because they own a corporation. They do not. The Who's Insured provision does not provide coverage to any owner of a non-owned covered auto. It only provides coverage to the named insured entity on the named insured line and a permissive user, which in this case the owner could be a permissive user who would be qualified under that, but the motor carrier form even takes that away. So we have to ask them who owns it. If they say, I own it personally, you got to drill that down, then you need to add 9947. Owner, which would be additional insured, employee as lessor. Employee, in my concern here, is the owner of the company, and there's a lessor to leasing. Now, some people say that that might have to be a written lease. There's no requirement to have a written lease. In fact, if you talk to lawyers or claims adjusters, what they'll tell you is that there's no difference between the enforcement at time of need between a written lease and a verbal lease. And the only difference between a written lease and a verbal lease, enforcement of that lease, is both parties remember what they agreed to. The only time the lease becomes relevant in that position and would be written if there's a disagreement. Well, I promise you that if I own the vehicle personally and also own the corporation or LLC that was using it, I would not forget that I leased that vehicle and agreed to hold myself harmless. So you don't need a written lease necessarily. However, I have had some underwriters who said they wanted, and back when I was a retail agent, I even drafted a very similar. Tommy Ruke, Ruke Transportation, agree to insure and hold Tommy Ruke, the owner of the unit, harmless while I'm using the unit as a part of my business, and signed it twice. So you need to come up with something like that. CA 201, those would probably be required here because that's the long-term leasing companies. That's the Pack Car, that's the Hertz, that's the Ryder that you're insured to using here. They usually require this as a part of the lease agreement. And this endorsement, CA 201, it is a disinsured and loss payee. The big part of this, providing the coverage of that loss payee, that would be more physical damage than liability. This does require a 30 days notice of cancellation or removal of that vehicle. The last one, CA 9916, hired auto specified as covered auto. This is what you'd use for owner operators, independent contractors. And all three of these endorsements then convert these non-autos to an auto, provide coverage primary, and allow you to list them in item 3 of the deck. They will cover the 9947 would cover the owner who owns a legal entity whenever the motor carrier is using that vehicle. It's a covered auto, get protection. CA 201 covers it based on that leasing agreement, and that would cover the leasing company as long as they're being held vicariously liable for the actions of the motor carrier who's using the vehicle. And if a crash happens, the settlement would have to include their name. The CA 9916, hired auto specified as covered autos for owner operator, has two factors. The first off, it would cover the owner operator who's the owner of that vehicle if the vehicle is leased to the motor carrier, and that would be requirement of the lease agreement to have the vehicle scheduled on the policy, have the vehicle that the insured is using as a part of that lease. The DOT number of your insured must be on the side of the vehicle that they did not own. That's the owner operator's vehicle, to conform with government regulation, and the bill of lading and the shipping documents would be in your insured's name, not the owner operator's name. That would be what confirms the lease. And then the second part of it is that the vehicle is being used on behalf of that motor carrier is leased to. This again would still require the owner operator to have the non-trucking liability coverage when they're not using that vehicle on behalf of the motor carrier. But all three of those then convert the non-auto to an auto so it could be leased. So we must find out who owns the auto scheduled in the name scheduled in the name insured. Then add the endorsement so that they properly have coverage. Symbol again, specifically described. It's specifically described and was not listed in item 3, possibly no coverage, but could be if newly acquired, temporary substitute, or hired auto that we'll talk about in a different section. Let's talk about, begins with what's a covered auto. If a covered auto must be described in item 3, the owner operator independent contractor unit will be described in item 3 and endorsement CA 9916 added to convert the non-auto to be a covered auto. This is an important part here for owner operators. We want them scheduled in the policy. We don't want them covered under hired auto that we'll talk about in another session, but we want to add to schedule. Coverage provided to the owners, owner operators, and independent contractor on a primary basis, again, as long as the auto is leased to the motor carrier, our insured, and being used by our insured. Agent gets a call from the insured. Just had a crash. Unit's not on policy because I just bought it or using it or any other reason. Do I have coverage? Your answer is, I don't know. There's too many moving parts here. I will turn the claim into our insurance company. You can explain to the adjuster why you were using a vehicle that was not on the policy. And if there's a problem with that, then call me back. You do not want to confirm coverage as an agent. This is too many moving parts, and you would want the insured to deal directly with the insurance company to determine this fact. There could be an insured because of the temporary substitute, certain autos, mobile equipment, and temporary substitute vehicle. This is C. This is a part of the program. It's liability only, not physical damage. Provide coverage to the following types of vehicles that are covered auto. 3, any auto you do not own while used with the permission of its owner, a temporary substitute for a covered auto you own that's out of service. So what we're saying is that we have a vehicle on the schedule, and that vehicle on the schedule cannot be used. It broke down, it's in for repair, it's in for service, it was lost or destroyed. We allow our insured to use another vehicle to take its place. And so in this case, when the crash happens and this other vehicle caused the crash, and the insured says, well, my vehicle broke down, I had to use this other one to complete the haul or to take its place. What the adjuster is going to find out, well, where is this covered auto? Let me look at the garage. Let me look at when it's destroyed. Let me see where the vehicle that's on the policy cannot be used the day and the time that that other vehicle is being used. There's also a component here that some people misunderstand, is how long this temporary substitute vehicle is covered. A lot of people say 30 days. 30 days in a minute, you'll see that's the newly acquired provision. But the key part here is not 30 days. It's as long as our covered auto is out of service because of one of these 5 items, then the insured has the right at no additional premium cost to use that temporary substitute vehicle as long as it's not owned by the insured. And so, but what happens is that most of the time, and think about your insured, they're going to go and who they're going to get this power unit from. Ryder, Pack Car, a leasing company. Most of those leasing companies, dealerships, Ideal Lease, those companies are not going to lease a vehicle to your insured without proof of coverage. And so now what happens, even though it's a covered auto, even if it's a covered auto, as long as that other vehicle is broke down, can't be used, out of service, what's going to happen is the insurance carrier is only going to be willing to provide proof of coverage to the leasing company for 30 days. Even though the policy doesn't have the limitation of 30 days, it's done from a practical matter. Because again, you have the factor that is a covered auto, but the people who own it, the leasing companies, are not going to allow that unit to be used by your insured without proof of coverage. So that's where the 30-day. The other thing is there's no premium for this because it's automatically built into the policy for those other units. That's something you will deal and work out with your insurance carrier, both from cost and the length of coverage they're providing proof for. But this will be a legitimate reason why a vehicle that was not on the policy the insured was using could raise to a covered auto. Temporary substitute autos. Modify the request to be described in item 3. Units out of service must be owned. If non-owned, the endorsement becomes a factor that we added to convert the non-owned auto to an owned auto. Unit must not be owned. The unit used must not be owned. That's the non-owned. and would not include an owner operator. Liability only, no physical damage. How long will be the temporary substitute to be considered a covered auto? No time limit as long as the covered auto is out of service, but proof of the leasing company might have a time limit in it. This is what we went through, and this is what you have to balance. The other area that might be a considered covered auto is something newly acquired. First off, if we use any other symbol with 67, which requires to be specified, then it would be a covered auto, any other symbols, which we'll talk about at the very end of the next session. There are two types of vehicles that could be newly acquired. We could start with the 4 units on the policy at policy inception, and during the policy term, we could buy a 5th unit. That's an additional vehicle. Or we could have 4 units on the policy, and we could trade one in during the policy term, and that new unit, the insurance carrier doesn't know about it, that's also newly acquired. We'll talk about that as replacement unit because it covers it, that auto, to make a covered auto in this way. First off, if it's additional to the operation, we already cover all autos that you own for that coverage, or it replaces an auto you previously owned that had that coverage. So what it's saying is that if it's newly acquired, added vehicle, we must own all vehicles that insured owns for that coverage. Liability coverage would be talked about in this section to have that newly acquired vehicle to be a covered auto. If it's a replacement unit, then we'll give the new auto the same coverage you have the old auto. So in the second case, a replacement unit, most of your insurers will have auto liability on all the units they're using. So if they trade one in, they get a replacement unit again, not owner operator. This is newly acquired. Acquired means they purchased it. They would have coverage automatically for that, subject to audit later. However, if it's a unit that is a additional to the unit, there's a little more problem with that, because a lot of times for liability purposes, your insured could own vehicles, pickup trucks, private passenger vehicles owned by the same legal entity that's not on our policy. So therefore you could have a problem with using this term, all the units you use, because it doesn't say commercial unit, it's all units you use. But even if it qualifies as a covered auto, you have a problem because now we have a time limitation. This is that 30 days. You must tell us about it within 30 days. That's the key part here. So it has to qualify as an insured because we're insuring all the vehicles the insured owns for the coverages and or it's a trade-in, and the unit we traded in had that liability coverage, and you must tell us about it in 30 days. So we're talking about vehicles only acquired, purchased after policy inception. We're not talking about owner-operators. How many small motor carriers can acquire a new power unit without proof of insurance? I contend not many at all. The dealership's not going to sell it. They're going to finance it to them without proof. They can't transfer the title without proof. They're going to call you up for the proof of coverage for liability and for physical damage. So when we talk about this, we're not really talking about new power units. What we're really talking about are ones that we might not get notification from the person who sells it to our insured. Typically, that would be a wreck unit where our insured buys it. They have a repair shop, they repair it, and they don't tell us about it until it's ready to go on the road, or they take over payment for owner operators. This is where our concern here is, because they're not going to tell you about it until it's ready to go on the highway. The triggering of coverage for the time limit is when they write the check for it, not when they tell you about it. And so we have to worry about this and explain to the insured, even if you buy one during the year. And again, smaller motor carriers will not be able to do this very often. Some of the ones with shop or different operation might do this. Back when I had a truck dealership, I did do some of this. This is where the glider kits come in place, where we'll buy the wrecks and we'll put a unit together. That's the kind of stuff we're talking about here. Then you got to remember the 30-day limitation that you have in it. So for new power units, new items, typically this would not be newly acquired. We'd already know about it. The ones that they buy and can get without us knowing about it is the one that causes our problems. So again, consideration: smaller risks will typically be required to list all vehicles for which coverage is desired. They will include all owned and leased vehicles. Because a proof of financial responsibility is required by the government, the insurance carrier is responsible to pay a judgment caused by an auto operated by the insured, even if not a covered auto, meaning not scheduled in the policy. Unit must be listed to be a covered auto, and we verify that for the units used through inspection reports or SAFER or other public information. If it's not a covered auto, now we have the 981X MCS 90, which only protects the public. There's no coverage here for the insured. It only protects the public, because if we ever have to pay a claim just because of financial responsibility when there's no coverage in the policy, the insurance carriers, as most of you know or should know, has the rights of subrogation back against the insured to recover what was paid because of meeting the financial responsibility that was provided to the federal government or state government that was not covered on the policy. Any of those kind of payments, the insured then has the rights of reimbursement from the insured. That's the key component here. So, covered auto required to be scheduled. Most commonly used for smaller motor carriers, specifically symbol 67. Must be found in the policy at time of loss or no coverage, maybe not even 30 days for newly acquired. Autos must be considered an owned auto to be specified in item 3 of the form. No problem, the insurance agent takes time to explain the requirement, and the insured understands and remembers. Do not operate a truck until you call me. This is the key part here. Strongly suggest, and we talk about this in advanced coverage, when you deliver the policy, you need to go over the requirements to be a covered auto with the insured. You need to have this as part of your checklist. And also, even if you don't have specified, even if you have any auto, the reporting provisions and or the premium provision, that needs to be explained to the insured. Our concern is insurance, what makes this unique to a motor carrier is for filings MCS 90 have no requirement for the auto to be scheduled in the policy to make the insurance carrier responsible to protect the public. The insurer does have to reimburse provision. Then the question is that collectible or not? So this is the problem with 67. It must be scheduled. Both owned and non-owned autos must be scheduled. Don't rely on the 30 days. The insured must tell us about all autos they operate. And if they use one they didn't tell us about it, then the insurance provider has a concern if it's not a covered auto, because they'd still have to protect the public. And when that happens, the insured would have a problem because the insurance carrier could seek reimbursement. So that's the problem with being specifically described. That's going to be most of the policies you write. You need to understand this and take time to explain to your insured these provisions. If you have any questions concerning this, please send an email to trs@mcief.org and we'll attempt to answer them to you.